Everyone talks in numbers, charts, and acronyms, but very few know how to turn that into real decisions. At the end of the day, the reward doesn't just go to those who watch, but to those who understand what's behind market indicators. Those who read early, who act early. Those who ignore them always arrive late. If this is your first time here and you still don't know me, it's a pleasure, guys. My name is Chad, and I'm a presenter here at Zero Markets. On the Zero Markets channel, our main goal is to bring clear and intelligent insights about the financial markets and investments, always grounded in safety, analysis, and the guidance of our specialists. An indicator is not a crystal ball. It's a lighthouse. It doesn't predict the future, but it illuminates trends, cycles, and points of attention. And when you combine these signals with strategy, you stop investing based on guesswork and you start investing with context, the same way professional investors have done for decades, following reports from institutions like the IMF, World Bank, OECD, BIS, and central banks. So let's break down the main indicators and, more importantly, how to use them in practice to make more informed decisions. All right, imagine driving at night on an unfamiliar road. The first set of headlights on that road are the market indicators tied to economic growth, GDP, industrial production, activity data. When the IMF revises projections upward, or the OECD signals industrial acceleration, the market senses the road opening ahead. That's exactly what happened in the US post-2021. Stronger GDP revisions pushed flows into cyclical sectors almost immediately. But then comes the headlight nobody likes: inflation. One of the most powerful market indicators, CPI, PCE, core inflation, data the market watches with the same tension as a championship final. Between 2022 and 2023, just one higher than expected inflation reading in the US was enough for the Fed to tighten its tone and flip the global sentiment within minutes. That's the power of a well-interpreted indicator. Continuing down the road, we arrive at the most sensitive dashboard of market indicators, the yield curve. When it steepens, the market interprets growth. And when it inverts, something closely analyzed by the BIS, IMF, and central banks, it flashes a warning of slowdown. It's like hearing the engine change pitch just before the hill appears. But the economy isn't just numbers, it's people. And labor-related indicators are almost a chapter of their own. U.S. payroll can flip market sentiments in seconds. A strong payroll means more consumption, potentially higher inflation, and therefore higher interest rates for longer. In 2023, that single indicator shifted entire sectors overnight. Then comes the emotional side, confidence indicators. When the Conference Board or OECD shows falling confidence, companies hold back investment and consumers slow down before hard data even shows it. This happened in Europe in 2022. The market read the confidence drop as a warning and protected itself months before the official decline in industrial output. And then we reach the headlight that measures investors' own mood. Indicators tied to global liquidity and volatility, like the VIX. When the VIX spikes, the entire market goes into defensive mode. And when it falls, risk appetite returns. In 2020 and 2022, the VIX practically dictated the behaviors of funds and managers worldwide. All of these signals, growth, inflation, interest rates, employment, confidence, volatility, form the mental map professionals have used for decades. And understanding market indicators is not about memorizing acronyms. It's about interpreting the weather that precedes any consistent move in financial markets. When you learn how to read market indicators, you stop reacting to news and you start acting strategically. Indicators don't predict the future, but they reveal the terrain you're standing on. And that alone puts you light years ahead of those who invest on autopilot. If this content helped you clear even 1% of your journey in the financial market, go ahead and subscribe to the Zero Markets channel, because here you're gonna find content that makes you think critically, clearly, and directly. There's no fluff, there's no pressure, there is no hype, just real financial insight. See you in the next video.